Hi, this is Stephen here from Share Navigator with an update on the Share Navigator options and futures trades. So these are trades that we place and we show our members how to manage on an ongoing basis. So we'll start with the first one, which is SPY. This was part of a three-legged option trade, and we've only got one leg left, which is the short 620 put. SPY is trading at 671 at the moment, so we're pretty much 99.99% guaranteed this will expire worthless and we will make our full profit. We're up $206 in this leg. On the entire three legs, I think we've made about $35 profit per contract. So nothing to do with that particular trade. The second trade was on crude oil, and we put on two different trades. One was the actual trade that we wanted to put out there, which was the short $55 put on the December futures contract. And the other was buying the futures contract outright. And we wanted to do both to illustrate the pros and cons of both strategies. So let me just remind you by going back to a chart. Here's a chart of crude oil. We put this trade on when crude oil reached this low here, which was a support area. But as you can see, that was at about $60 to $61. And you can see next support here is at 55. So in order to trade crude oil, what we could do is just buy the December futures contract. And when crude oil goes up, happy days, we make money. But the probability of being profitable in that is 50%. It's like buying a stock. On any given day, it can go up or it can go down. It's a binary impact. The other trade we looked at, instead of actually buying the futures contract outright, what we did was and sold an insurance policy that expires at the end of October to basically deliver that futures contract to us if crude oil drops to $55 a barrel. That's ultimately what the trade was. So in other words, with that, we get paid an insurance premium up front for ultimately guaranteeing the value of somebody else's crude oil futures contract that expires in December. And like any insurance policy, it doesn't come for free. We get paid for putting that on. And if we go back to our position here, we got paid when we put it on here $487. You can see it's a minus figure here because that's because we don't own it. So what the transaction actually happens there is the cash goes straight into your trading account, but your position will always show a minus value. So you can see the current value of the position is minus 221. Why is it a minus? We don't own that put option. We sold it. We sold the insurance policy. And we want the market value of this to disintegrate to zero. That's when we make our entire profit of $487. So right now, we've got an unrealized profit of $266. So that's the initial income that was taken in. That's cash gone into our account. Just imagine now we wanted to close ourselves out of this position. We could go and take $221 and buy ourselves out of it, which would leave a net profit there of $266. So that trade has gone particularly well. Now, if you remember yesterday, when we looked at this trade was on an unrealized P&L of $800. It was way up. Look where it is now, $192. So this is the pros and cons of each strategy. Yesterday, this strategy was a much better strategy to apply. That's where we just bought the futures contract outright. We didn't kind of give ourselves any leeway for things to go wrong. And look at it now, it's actually down to $232. Whereas our put option contract that was put on at the same time is actually up, even though crude oil hasn't moved up or down. And the reason for that is, if you think about it, let's talk about the first strategy. You buy the December contract, you need oil to go up to win. If it goes sideways, you don't win. If it goes down, you start losing. With this strategy here, think about it, we win so long as crude oil stays above $55, minus the premium we took in. But let's just call it $55 for whatever, just to keep it simple. So as long as crude oil remains above $55 between now and the end of October, we make our profit no matter whether it goes up, it goes sideways, and it can even fall as low as $55 and we still make a profit. So that's the beauty of doing the short put strategy. The negative of doing the short put strategy versus buying the crude oil contract is, if crude oil, for example, shot up to 70 here, you would make more money owning the December contract. We will only ever make, when you sell a put option, all you will make is the premium you took in for selling that insurance policy. That's all you can ever make on it. That's the max profit you will get. Whereas if you owned the futures contract outright and oil goes on a tear upwards, you will make more money. So there's pros and cons to each strategy. This is a safer play. It's a higher probability of profit, and it gives you like I think our trade on that was 86% probability of profit. So we had a really high chance of winning. So now what I'm going to show you how to do now is actually place a closing trade in this. Let's say you said, look, I've said over the last few days, if the value of this contract gets down to $90, and remember, this is a 1,000 multiplier option. It's not a $100 multiplier option. We want to close it out. So what we will do is just click on the three dots on the right-hand side. We're going to click on close. This will bring us into this trade screen here. We're going to change the order. We're going to leave the order type at limit. And what we're placing in here is 0.09. Remember, it's a $1,000 multiplier. And we change our time and force to good till cancel. Click on buy order. And that's it. Our order's gone in now. So in other words, we don't have to keep watching the screen anymore. So the minute the value of that put option contract drops to $90, basically, we're going to be out of that trade and we'll bag about $400 clear profit. So that's the beauty of both strategies. We've nothing to do with any of those trades at this moment in time. We're going to leave on our short 55 put, and on SPY we leave on the 620 put. So nothing to do, but I just thought it was a very good highlight of how things can change in the space of a day. Something that was up $800 yesterday is now down 200, but our put option is still up. And that's because we had a hell of a lot more outs. We can get out of that strategy with the price of oil even falling and still make a profit. Okay, this is Stephen with an update on our options and futures trades. Thanks and bye for now.